Okay, good morning, everybody, and welcome to the Daily Energy Markets podcast, Sunday, November 7th. The opportunity to reflect on the week past and indeed a significant week, you would say, on so many levels. I'm going to kick off this morning with Mike Muller, head of Vitol Asia, sitting in Singapore. Mike, of all the things to reflect on last week, let's kick off with the OPEC meeting, because from that, I think many tangents come. But essentially, the rollover, nothing happened, and yet everything happened. Particularly, in essence, the headline seemed to be OPEC rejecting pleas by Washington to increase supply. Your thoughts on the decision and the sort of noise around it?
Right, thank you, Sean. The decision to roll over the 400,000 barrels a day for the month of December shouldn't come as a surprise, because these monthly meetings happen at a point in time which is somewhat late to catch the Asian trading cycle for crudes, and therefore the December trading cycle had finished trading just before the OPEC meeting. There was, of course, an opportunity, as pointed out by many observers, that OPEC could possibly take note of the fact that inventories have now depleted to pre-pandemic levels, and therefore they've really accomplished what they set out to do in many ways, to perhaps tease out whether the market was there to take a bit more oil in the peak demand month, certainly for Asia, of December and January. And the fact that they didn't do so doesn't come as a surprise to most traders, but the market certainly bought into it initially. But immediately this got juxtaposed with the tensions you refer to, where there was now a perception that perhaps OPEC's actions had somehow angered those nations, including the US, that wanted to see gasoline prices at the pumps brought under control for reputation political reasons. But the point to make in America is, there is no political challenge to the Biden administration now for about a year, right? You've had two, we'll call them by-elections in UK terms, in both Virginia and New Jersey. New Jersey, he narrowly held on to. Virginia, he lost, right? But there's no real midterm point in time where an appeasing move needs to be made to swing the electorate in the Democrats' favor, which is what an SPR release would accomplish. And of course, all the talk of the SPR release, or at least as mooted, sent the market down from 84 down to $80 in the space of a very short amount of time, and fueled speculation straight away whether that was the that was the right sort of expectation built into the market, because the market does seem to have an inbuilt expectation that there will be some form of SPR release. Otherwise, why would it have moved so much? Then came the interesting event of Saudi OSPs, out uncharacteristically right in the middle of the Arab weekend on Friday night, Asian time certainly, with an unexpectedly larger than expected increase in differentials to most parts of the world, but most importantly for that benchmark volume to Asia. And onlookers, experts expected big increases. So the fact that there was a big increase was not a surprise, because that's the nature of the market. We have better refining margins, we have stronger sweet markets, we have benchmarks such as IFAD, Murban, trading a lot stronger, and these all serve as guiders to help the Saudis set their OSPs. But they went further than anybody expected, and that was immediately seen as a signal to those that were critiquing OPEC Plus for not putting enough oil in the market, that the Saudis felt that they can indeed make higher prices stick. It's notable, however, that term negotiations for 2022 crude oil supply from Gulf producers, OPEC producers, are now done. Because of the nature of how this oil prices, it started pricing last Monday for most contracts, and therefore the OSPs no longer serve the purpose of seducing term customers into an oversupplied amount of OPEC oil. That's no longer the case at all. The market is definitely in a position where inventories are low. There is a perception in markets that crude supply is tight, and the Saudis are pricing their oil accordingly. And whilst January trading hasn't yet started in earnest, there's been a very interesting standoff between buyers and sellers, but sellers have all backed off on differentials for crudes into places like Asia by $1 or $2 per barrel. And that all dives.
Christoph Ruhl, Senior Research Scholar, Center on Global Energy Policy, Columbia University, Sunday morning anchor of the podcast. Christoph, there's other reasons perhaps why Joe Biden was screaming for more oil, and that is the cost of energy and the inflationary pressures it's putting on everything. There is real economic pain here from the point of view of upward pricing of everything. We saw last week the tapering finally begin with the Fed, and then we saw sort of robust job numbers on Friday. Your thoughts from last week on the sort of macro side and monetary side?
Good morning, first of all. I think there's several strands of reasoning which can explain his behavior, which looks pretty silly, to be honest. No? First of all, it's a time-honored transition. I think every single president since I don't know when, whenever oil prices went to sort of half the historical record, started screaming at others to increase oil production. Secondly, there is, of course, the widespread perception correctly that it was the Biden administration who was trying to sort of induce producers, US producers, from doing less and restrict access to foreign land and generally support attempts to produce less hydrocarbons in the name of climate change or avoiding climate change. And then there is the factors, the economic factors which you mentioned, that a continuous rise in the oil price would indeed put additional fuel to the inflationary fire. The US now is living with inflation rates of 5% for a few months now. This is higher and longer than the Fed, not to mention the government, had ever predicted. And so putting rising oil prices to that for a sustained period of time increased it further. But one should be careful here, because a one-time increase in the oil price is just a shift in what economists call relative price, the price of oil relative to other prices, and will not show up as inflation over time. It would require continuous increases to be inflationary. But food prices are increasing, commodity price increases, all of that. So having said all that, I think the Biden administration really did itself a disservice with this, because all around the world, and that's not lost on OPEC, of course, they look silly. They are the ones who asked their own producers to take it easy and slow down, and raised all sorts of perspective of obstacles. And then they turn around and are begging OPEC Plus to produce more. And we know that, on the other hand, I think it's pretty obvious that we have Saudi Arabia and Russia on the table now, not just Saudi Arabia as it used to be, answering these calls, that they are in no mood of leaving a cent on the table if they don't have to. And they're probably telling themselves, okay, maybe there's a bit of inflationary impact, but $80, $85 is not really killing the global economy, because they base their judgment on the experience of the last few years, not on necessarily on the acute situation. So I think that's why OPEC had no reason and no incentive to react to these calls. In fact, it would have require these calls, it's like a ritual a little bit, and this is the first wave of calls, so they have to get a lot more.
You got. I suppose it's always good to. It's also good to have somebody to blame. Mike, you put the structure of the idea that the market came off ahead of the OPEC meeting, but perhaps also I'd put it to you, the market came off ahead of the Fed meeting, the tapering. What was going to happen? All markets seem to pause. With the expectation, of course, of what happened. But now, like equities, are we set up for a big rally in oil prices?
There's many ways of answering that, Sean. And yes, I mean, the S&P 500 is at
yes and no is the starting point.
So it looks like you're happy with that, Sean. But I mean, we are. Oil has, as was so nicely put forward by His Excellency the Saudi oil minister, is still the laggard in the energy complex. And you have to have a little think, what happens to those commodity index funds, which tend to recalibrate at the end of every year? And in dollar terms, if they want to keep the amount of oil in their energy basket or commodities basket constant with where it was calibrated a year back, they need to buy more barrels of oil to keep oil in monetary terms at an equal sort of percentage in that pie chart. And that would have the effect of taking oil that has been lagging other commodities and having these index funds see more oil bought in the recalibrated numbers from January onwards. The other thing is there tends to be producer hedging at this time of year. The most famous one, the Hacienda hedge from Mexico, was normally done at this time of year. But the interesting vibe coming out of North America is that many of the sort of Permian royalty, the big names in the Permian Basin are not oil majors, have come out with statements that they're no longer hedging. And in fact, there are some people out there who observing markets, and of course this is anonymous futures trading, but are opining that some of these producers are actually lifting their hedges. So they're buying back their forward sales or their put options. And if you look at the back end of the oil curve, it has done something remarkable. It has moved up. So at no point in the forward curve, all the way up to 2029, 2030, can you buy Brent for less than $65. And a few weeks back, that was still low 60s to high 50s. So the back end of curve has been lifted at a time when the front end looks a little bit wobbly based on will there not be an SPR release. And by the way, not just from the US, but there's all this mooted concerted action to bring about SPR releases in other countries also.
Christoph, the same question really. Does the Fed finally sort of showing its hand, I mean, and taking its plunge, sort of clear the way for markets now to move forward? And particularly, again, on the commodity side, we saw a slight correction down to 80 on Brent. Now we saw the bounce back in the end of the week. But with the Fed out of the way now, there's a free runway.
I mean, we should distinguish some, as I say again and again, sort of long-term trends from the short-term wobbling. I think I take some kudos here because I, on your program a few weeks ago, said I would sell oil positions before when they reach 85, right? And that was based on saying that there are some long-term trends here and a relentless rise of the oil price or further rise even of energy prices, absent extra cold spikes in the winter, is not one of the long-term trends. What we see in the rest of energy, gas and coal, is the return of a globalized commodity market. So these are cyclical ups and downs, maybe a rising trend, who knows. What we see in the oil market is a long-term trend is too much oil on the world still. It's a political decision of OPEC to constrain supply, and how that pans out will depend on economic growth in 22 and on supplies from the US and other private suppliers in 22. These look pretty strong. I heard the same about shale producers dropping hedges. I'd be surprised if it's true because it doesn't make much economic sense to me. If you have 80, 85, you can lock in some production that would do you good for the next year. And eventually even US or just especially US investors will react to the carrot of high prices. On the economic demand side, I think the long-term trend is also one of slowing long-term growth. We have worries about growth, not just about inflation. The Fed starting to taper is not, as one of the headlines says, starting to put their foot on the brakes. That is just to take the foot a little bit off the accelerator. So the creation of money in the system continues, has been drawn down a little bit, but plan B, the rise of interest rates, which would be necessary to curb inflation, it still seems to be very far away and seems to be impossible to do without a major market tantrum. And if plan B, the rise of interest rates, is not coming anytime soon, then we will see inflation hurting growth.
So that's ultimately, I suppose, the question. Mike, coming back to the OPEC narrative, we talk about OPEC declining to raise supply beyond the current sort of 400 per day per month. My question to you is, can they, if they wanted to, increase supply? Where are you on the view that actually, bar Saudi and maybe the Emirates, OPEC Plus is maxed out?
That's a really good point, Sean. I think we are close to that, and we're certainly at that point in the OPEC Plus community. A lot has been made of the fact that there is no good explanation for why production from Iraq has not been at or slightly above their OPEC Plus quota level. There is talk about maintenance in the kingdom. And of course, Christoph, I need to come back on this glut of oil, or plenty of oil out there comment. I mean, if you scroll forward a few months, and if we see a good demand winter, and we'll come on to weather later perhaps, Sean, because I think it's important, the discretionary spare capacity is really only in the hands of 2 or 3 countries. And that's indeed it's Kingdom of Saudi Arabia, it's the UAE who say they use it 4 there, and I guess Kuwait.
Exactly. I call it a political decision.
Yeah, indeed. Okay, so we're in the same place.
But it's concentrated.
But the spare capacity, as projected forward, if there is no relaxation on sanctions on Iran, if we continue to see nothing much coming out of Venezuela, and if Libya continues to be troubled, will very quickly go down to levels that cause some people angst. I mean, right now we're still talking about a supply cushion of several million barrels per day, but come middle of next year, that is a very small level. And this is a pinch people are concerned about because they do not see the investment going to the US. And what little non-OPEC investment has taken place, giving us extra oil from Johan Sverdrup and from Guyana and places like that, is not enough. And just look no further than those OPEC Plus member states from West Africa. I mean, Angola and Nigeria, month after month, their programs are coming out thinner than expectation. I mean, the peak of their production would seem to be in the past, unless the oil majors that's basically responsible for most of the complex deep water projects in places like Angola put their hands in their pockets one more time and do another round of deep water project investments. And look at all the rhetoric coming out of COP26 on that.
Christoph,
go ahead, disagrees. Let him have a go, Sean.
Yeah, I mean, jump in. I wanted just to touch on pick up on the point of the limitations and the constraints and the restraint that OPEC Plus is showing, but also equally on the oil major side in the US. Are we seeing restraint by the majors in the Permian on shale, or is it economically not viable? Why are we not seeing more barrels come out of the US at $80 on Brent?
This is a problem, and this is part of the explanation why supplies are reacting so slow. But it's not only the majors in the US, it's the majors globally. Because recall what has happened. I mean, even at these kind of oil prices, when you look at the Shells and BPs and Exxons of this world, they all have giant share buyback programs, and they're all hesitant to approve big oil and gas projects. And why is that? That's because of shareholder pressure and political pressure and all the rest of it. It is completely ill-conceived notion that you can start the energy transition backwards, so to speak, by curbing fossil fuel supplies, and then somehow renewables will be stepping into the gap. It's not how it works. You have to start on the demand side. That hasn't been done. So we have a situation where everybody now talks again, even in oil markets, about an investment gap. Normally, I'm the one who always says I can't hear it anymore, because every 3 years, people, especially oil producers and the IEA, talk about an investment gap and paint these horror scenarios which never come true. This time, there is more reason to talk about an investment gap than any time I can remember since the 80s. I don't know if there is one or not, time will show, but it has a lot to do with this shift from Western private producers, including in the shale and in the US, to state-owned producers in the rest of the world, which comes from curbing supplies for a variety of reasons, but the biggest one, which holds them all together, is environmental concerns and ill-understood sort of support of the energy transition in one form or another. And that shift, which the IEA projects OPEC share to go in total oil production to go from 37 to 52%. That's a sizable shift, and that of course gives them more power. We see now how it is used with spare capacity indeed be concentrated on the Gulf and used to keep prices up. And it's easier, of course, for OPEC to do that with 3 countries than with 17, if they all have a little bit spare. And it's a shift which has barely started. And I don't see the BPs, or for that matter, Chevrons in the Permian of this world, going back very quickly to an aggressive oil production mode.
Well, certainly not with the profits they're making without doing it. You just tend to wonder, what would you do it if it's all broken? Why fix it? Mike, you spoke about the winter. I'd welcome your outlooks on that. The cycle we're going into, which is 2 things. One, the end of the year and the structure that has on the impact of traders and market makers closing out positions and so forth, but also the winter. You see in China, I mean, man actually just arrived in Muscat this morning. I'll be meeting all my clients here. I want to know what's going on in China, because that's what they'll want to know. China's cold weather, they got a resurgence of COVID, and yet they have an energy crisis.
Yeah, what's going on in China this morning is first snowfall in Beijing. So I've got lots of pictures of white streets in various parts around the capital there, and it was expected. There is a polar cold mass that has moved its way all the way across China. In fact, it's causing colder than seasonal norm temperatures all the way to the south of China, in fact. And I must say, from this trader's perspective, and that's just me, I don't think I've ever seen the world as concerned about a cold winter in more than a decade than it is the case now. And of course, we're still well ahead of winter in terms of trading terms. And this is not just about oil, this is about coal and about natural gas, because it's been well publicized that coal inventories have been evaporated in many parts. I mean, India was on its last crumbs, and Chinese inventories were so low that they had to reverse a directive to go and crank up production again. And they're now getting it close to record levels of 12 million tons per day. But this feeds through into the natural gas scenario, where nobody wants a recurrence of last year's winter natural gas spike. When we're coming off the back of the last 2 months, seeing natural gas prices that were at or above that last winter spike, which was caused by power shortages in Japan and extreme cold weather in Japan and Korea. So, I mean, Seoul and Tokyo are still balmy and 19, 20 degrees, but they're coming off soon as well. And this is to do with weather cycles, and more specifically the La Nina weather pattern, which generally allows colder polar masses to come into that Japan, Korea, China, northeast corner of Asia, where there is so much demand. And it is of concern because there's a lack of clarity around gas inventories and adequacy of LNG supplies. And whilst you'd assume that the regulators in Japan and Korea will not allow a repeat of last year, look no further than Europe. And maybe I hand over to Christoph at this point to comment on, whether or whether not there'll be Russian supplies, and why on earth it is the case that we're seeing now for a second week running supplies of gas moving from Germany into Poland rather than the other way around, and what all that
Just
rhetoric is
sticking
about.
with just sticking with China for a second on that point of view of shortage. I mean, clearly they've still have a significant amount of oil in storage from stockpiling last year. Is there an ability to bring that to crossing over to power generation? Is there enough coal? What sort of winter does China face from a shortage point of view, do you think?
Okay, there's a few things there, Sean. Number one, China is a major part of the switching from gas to oil where that is possible. So there's a fleet of LNG fueled trucks which don't make sense to run at spot marginal prices and therefore should be seeing themselves replaced by diesel fleets and so forth. There's coal to gas to liquids manufacturing processes which have been halted as well in China. It's pretty much the only place in the world that does it. But yeah, China's gone through a cycle in the last few weeks where there have been shortages and embarrassments in terms of brownouts and traffic lights not working in some of the northern cities, to edicts from central government not to run out, to a depletion of the Australian coal that is still not open for trade, but there were stockpiles sitting in China and ships sitting off China, which have all been sucked in to the tune of about 1 million tons, and a clear build-up in LNG stocks. And then there's the oil you referred to. China was going to release about 27 million barrels of oil in 3 phases, in 3 chunks of 7 million barrels each, in the months of October, November, and December. And we saw the first cycle where only 4 and a bit million barrels of the 7 million were awarded. Only domestic companies can partake in this, of course. And there's no sign of the second release at present. And there always tends to be a bit of an overtone of price on this. But if China had conviction about sticking to what they said they were going to do, we would have seen the second tender by now. We have not yet seen it. So my personal view is that China is very much in inventory building mode because they don't want to be caught short in a colder winter. And they have had extremely high domestic prices. I mean, for a couple of weeks in October, China had the world's highest LNG, coal, diesel, and gasoline prices. And they very successfully talked this down by policy and by edict a couple of weeks back, such that the steam got taken out of the whole thing. But you cannot move markets with words. In the end, it's all about inventories and it's about behavior at the spot end of the market. But yes, watch this space. China is very much in a state of flux on, NDRC rhetoric and directives vis-a-vis real demand. And as I said a few minutes ago, there's a bit of a standoff in crude markets where the Chinese buyers for the January trading cycle haven't come to the table yet and are now faced with offers that are $1 or $2 a barrel higher as differentials versus Brent or versus Dubai than they were a month ago. And the view on the street is they will bite because they need to.
The bite because they need to. Well, that's not a good position to be in if you're a buyer. Let's go to the survey and then get Christoph's views on the energy crisis in Europe vis-a-vis also COP26. So back to where we started, the Fed's tapering is too little too late to guide the Titanic world economy away from hitting the inflation iceberg. Agree or disagree? The Fed tapering is too little too late to guide the Titanic world economy away from hitting the inflation iceberg. Agree or disagree? Christoph, just flipping it over to the European version of the story that Mike just painted, and also within the context of COP26, it seems in some way these two are separate events, but somehow they're getting merged into the one event, i.e. COP26 and the shortage, the fight against climate change being blamed on the shortage in Europe. But your thoughts?
I mean, first of all, we have to be clear when we always talk markets do this or think that, markets are not beings with independent thoughts. They are signal processing mechanisms, full stop. And what happens in places like China or so is that economic growth goes down and the Chinese are not stupid. So it's exactly like Mike said, they're preparing for a winter without inventory shortages. And generally the world, I agree, it's just looking at this winter like the rabbit at the snake. And it's very funny because if you think if this winter would not only be harsh, but also be another COVID winter with lockdowns, we wouldn't have so much of an energy crisis, it wouldn't double up. Right. So it's a very funny situation. To your question, I think that the European situation is sort of calming down a little bit in terms of prices. They are becoming more or less a function of LNG prices elsewhere, coal prices elsewhere, which are now sort of driven more by Asia. I think what Putin's announcement that he would resume deliveries to Europe did was it calmed the prices in Europe, the spot prices a little bit, but it also hit severely the share prices of Gazprom and Novatek, the gas companies in Russia, indicating that the market, believes, if I can use these words now, that he has the power and the will to deliver on these pledges, so that these are not independent companies, as we of course all know. And what happens next is entirely, as Mike said, for Asia, a function of the weather. We have not seen yet attempts at reducing the carbon price to get energy prices down. Every government in Europe is thinking about subsidies, but they all have been extremely carefully to keep these subsidies away from the discussion of the energy transition. Because the last thing anyone in government wants right now, after they had this big event in Glasgow and everybody is talking about climate change, is to be called out in a situation where they have to make the connection between high energy prices and climate change. Is there a connection? Yes, there is, but it's probably at the moment still weaker than most people think. There is a connection through the replacement of coal with natural gas, both in Asia for local environmental reasons more than anything, and in Europe as part of a program. There's also a connection of this replacement of nuclear power in Central Europe with natural gas, which is not motivated by climate change, is motivated by fear of nuclear, even though these are also environmentalists. But overall, there was an attempt to move the European gas market in particular to a spot price system, which would be perfectly aligned and fine with a world in which gas deliveries move away from bilateral pipeline relations to globalized integrated LNG trade, but which is something which Russia has deeply resented. And so Gazprom has sort of being pushed and forced in order to live with spot prices, has gotten very low prices for it for a long time. And now they're just doing the bare minimum. They fulfill their contracts, but they say, okay, on everything else, we can now wave our hands because we are no longer long-term obligations here. We just react to market prices like everybody else. That's the card Putin is playing. That's in the long term, of course, a losing proposition. But right now, the European Union looks as if they had messed up this transition from long-term fixed prices to short-term spot prices.
Mike, just quickly, your thoughts. Have you heard anything from COP26 Glasgow that sort of surprised you, gave you pause, that might influence the markets on the front end, on the short term? Obviously, it's a lot of long-term stuff, even India, talking about 2070. But anything coming out of COP that you've heard that might influence the market fundamentals over the short term?
Short answer, no, Sean. Everything's pretty much gone as I would have expected to see so far. But
Could there be anything that could come out, do you think, that could influence the front end of the market?
I mean, we've already had the motion that OECD countries lean on lending institutions to pull back on lending, not just to the coal segment, but to fossil fuels, right? Which, of course, anyone knows if that were to happen too quickly, then the world has a problem with mobility and with development of society. So that has to be a much more orderly process. So I don't think that sort of statement was market moving to my mind. Article 6 is the big one, I think, which needs a bit more attention, and I don't see any progress on that yet in terms of the fungibility of carbon offsets, which is the mechanism by which the world can manage the discrepancies and the imbalances in a more orderly fashion and set the right price framework to do so. Christoph will have views, I'm sure, because he's leaning forward here. Give him a turn.
Yeah, let's get the survey result to give Christoph the last word. So they agree, kind of in this room at least, that too little too late from the Fed. On that US side of the Atlantic, Christoph, we had just overnight the final sign off on the US $1 trillion infrastructure bill. And you didn't mention yet the jobs report on Friday. Do these two things give wind to the sails of this week, setting up for what I think could be a big upward move in the oil market?
The job market figures, they jump around in a very similar fashion to oil prices. The question is, where are they jump? What's the underlying trend here? And yes, it could be this. I mean, the signals are clear. The spending continues. The Fed is doing no more than was expected. The infrastructure and fiscal expenditures, yeah, exactly, go up. Lagarde has basically also said we will not raise interest rates in Europe anytime soon. And now the jobs are bouncing back, which are, mind you, these are women coming back to work in low-paid jobs, which are, have exhausted their COVID savings in the bank. So that indicates to me still, slowing down economic growth, which is going to be more labor intensive, more need for people now to spend. And we have to see how that translates into economic growth. I remain there a little bit more on the skeptical side. And don't forget that everybody has overestimated so far completely oil demand because of these efficiency gains we have in oil consumption. On COP, I think there's one thing interesting. It's true, no short-term, the two short-term factors would have been globalization of the carbon market, that hasn't happened, and a breakthrough in what counts as offsets, that hasn't happened. What's interesting, there have been positive surprises, but they're more in the direction of protecting forests and biodiversity. And I think that's actually a very good way to go. If the world could just, park a part of the planet under protection and sort of keep humans out, that would probably be better for the environment than all these other things we're talking about. So hopefully,
well, we probably need to wrap it up there. I'm wondering, after last week, and it's something that's been percolating for a while, is like we've sort of got used to it, money being free, 0% interest rates. Do we now have the counterpart of that and have to get used to inflation at 5%, and that's the new normal along with free money, rather than this sort of idea that someday it will be tackled, someday interest rates will return, but clearly
now
that day
an
is
economist.
not arriving.
Free money becomes useless.
I know. I mean, what can I do? I'll have to go back and get my PhD. That's just to reverse into that gear. But we look forward to.
I hope you've got your hotel rooms booked in the Emirates for your long stay with your family, Christoph. Because if you look at prices in the tourism sector, they're certainly trying to make some money back there. Try booking a room at Jumeirah Beach or Atlantis.
I will go to my bank and ask for a huge loan, to finance that, and then I pay it back much cheaper.
I was in Fujairah last week, and I was at the Novotel, visiting the Novotel, not staying. The Novotel, as you know, is a 3-star hotel, I think, in Fujairah. The prices on the weekend were over 3,000 dirhams, nearly $1,000 a night in a 3-star hotel in Fujairah. I mean, if you want inflation, my goodness, it was startling. I took a picture of the board because that was so high. Anyway, that's enough rubbish. Mike Muller, as always, awesome to have you from Singapore. We look forward to seeing you in Abu Dhabi very soon. ADIPEC around the corner. Christoph Ruhl, the same. Thank you so much. Have a safe journey to the UAE, and we'll see you in the coming days. And everybody else, thank you, and we'll catch up every morning, 10:30 UAE time. All the best.
Bye-bye.
Thanks. See you.